Hello, this is Johnson Wu, a Maxwell agent. As you know, our company has a mortgage business operating under the name of Googain. Today, I'd like to devote a quick mortgage video for those individuals who have been denied a loan by the banks. It's not end of the road, you have options, and I'm here to tell you how. You know why you were denied? They probably cited reasons of too much debt, not enough income, whatever the reason. Simply, it is because you didn't fit inside the QM or qualified mortgage category. Now, we can spend hours defining what's qualified mortgage, but we won't do that. In a nutshell, qualified mortgages are mortgages that meet certain requirements, loan limits, and lending guidelines set by the investors or government agencies who will purchase these loans from the banks after closing. For this reason, banks are incentivized to focus on QM lending, but that leaves many potential home buyers who do not fit perfectly in QM category fall by the wayside. This is where non-QM programs can bridge this gap and help these people get the approved financing. Non-qualified mortgages, for most parts, has more lenient underwriting requirements, but it doesn't mean that they're bad loans. In fact, the lending requirement is like QM, but with a more common sense approach. Let me share with you just how some of our company's non-QM program can help. One popular non-QM program is the DSCR, or Debt Service Coverage Ratio loan. Now, these loans are used by investors and it's very popular. In the simplest way to understand, DSCR is when an investor looks at a rental property and see if the presumed rent is going to be higher or more than the housing payment, or PITI. When you take out a DSCR loan, the bank will look at the appraisal report with the rent schedule and determine what the market rent is for that property. If the market rent is higher than the housing expense, then your loan should qualify. A very simple example would be an investment property with a monthly rent of $1,200 and a housing expense of $1,000. You divide $1,200 over $1,000, you have a debt service coverage ratio of 1.2. Anything over 1 will qualify the loan. This is the perfect program for someone who wants to buy one or multiple rentals but cannot qualify based on their own income. The kicker is, the rates on these loans are not bad. They're typically 1.5% to 2% higher than regular QM loans. Pretty straightforward and makes common sense. This is why DSCR is so popular. Now, another popular non-QM program is our bank statement loan. These are high-quality loans used most likely by self-employed, who makes good money but writes off many expense items, so they don't qualify on paper. In this program, we will look at the aggregate monthly deposit in their bank statements for the past 24 months and apply a sensible expense ratio. These deposits will serve as proof of income and that they have been self-employed for a minimum of 2 years. Here again, we have a straightforward, common sense approach. I think you get my point. The non-QM programs use common sense instead of steadfast ratios or percentages set by the QM investors. We all know that everyone's financial situation is different and not every homeowner fits perfectly in a QM loan. If this is your situation, we at Googain can help you find the appropriate non-QM program and get you the financing you need. So don't waste any more of your time shopping for a traditional QM loan. A non-QM borrower is like a square peg, and no matter how hard you try, it's not going to fit into a round QM hole. Should you want to learn more or know of anyone who may use a non-QM loan, you can reach me at johnsonwu@googain.com. This is Johnson Wu, and I thank you for your time.